sense in terms of how one's portfolio should be skewed when it comes to debt versus equity? Is there a bit of rebalancing that needs to be done?
Yeah, rates have risen quite significantly. If you were to see shorter end, they're up by almost 3% from what you saw a year ago. And even long end is up quite substantially. Right now, if you were to buy, let's say, a 3-year short-term fund or corporate bond fund in India, you would get close to somewhere between 7.5 to 8% yield. And long end, somewhat similar if you buy state loans or corporate bonds. So essentially, near 8% is what you can expect if you were an investor for 3 years. If you actually look at ultra short end, which is 3 months, 6 months, 1 year, it's a very short term money. If you have, there are opportunities available in the market today, to buy at 7.5%. So people don't realize this, that how quickly the whole rates landscape has changed over the last 1 year. You could barely get 4-5% a year ago, and which is why there was a TINA of sorts. But now, the whole rate complex is significantly higher, and your money actually, even in peaceful places with low volatility, can earn decent returns.
Maneesh, if you look at asset allocation right now, would you say that you are safer in investing in fixed income products? Well, up until now, the India market resilience has shocked everyone, but we've proven strong on that. But you never know, given the rising interest rate scenario, if the US were to slip into recession, how long will be able to actually stay decoupled?
That's the argument, that basically, if we are going to we're going to get a lot of volatility and a very little excess return over bonds. So if you're happy with Indian markets outperforming with vis-a-vis rest of the world, then good luck and it's actually fine. But if you're looking to earn equity risk premia in India as well, or perhaps anywhere in the world, you're going to get disappointed given the turbulent times, which are ahead for us. So to that extent, I would say, given that the rate markets have adjusted significantly higher, and you cannot make the argument that rates are not compensating well enough, I guess it is a reasonable time, particularly in the next 3-4 months. As I argued on your channel many times, this December-March period, you will get absolutely gangbuster yields, on 3 years, 5-year bonds, and which is where you should place incremental assets or your money to.
Good morning. While we talk about corporate debt emerging as a new asset class, there's data also coming out that we are seeing the emergence of that. Maneesh Dangi, I thought it'll be a good time to also ask you that when we look at this asset class and it's becoming better, some people say, why do you have money in fixed deposit? One should keep in mind as well that it's is it a more risky asset class? Like, what kind of a risk appetite should one have?
Are you asking risk associated with bonds?
Yes, if I'm going to be going in for bonds, which are then related to corporate debt, and we're talking about its emergence, it will be more risky, right?
No, we're talking of actually bonds in the AAA space, high graded, very liquid bonds, which are lying in good quality corporate bond funds in the country. They're very, very liquid and as low in terms of risk, credit risk or liquidity risk as you can get. So I'm not actually still discussing the AA and A space, which is completely broken right now. You can actually get a AA from low leverage in India at 9.5% and if you actually try and flirt with something like A's, you are in the catchment area of 10.5, 11%, or at times even higher. So after very long, for near 2.5 years of winter of sorts in bonds, you have a very warm weather up there, and you can get a lot of opportunity. The point that I made in the beginning was that even for the investors who are not looking to dial any risk whatsoever, you're getting a near 8% yield if you sort of lock your money for 1 to 3 years.
The winter for the bond season giving its way to the spring season. Maneesh Dangi, we always keep coming to you, right, because of your macro investor themes. I remember it was about a year ago, you were right here on ET Now also saying that you're putting your money now in farmland. Corporate debt, bonds. Have you been investing in this as well? Like, is this a time when one should even look at increasing the exposure?
So I'm a market timing guy, So in a sense, every season, people who actually keep the sort of a thali, they don't bother about just one dish, be it equity or fixed income. So if the thali has everything else, you would realize that in every season or cycle, there is an asset, which is actually looks cheap. The positioning is decent, and then it makes sense to sort of pile onto that trade. So about a year ago, one and a half year ago, sort of made arguments with many that, Indian property market and land in particular actually looks really cheap. And since then, of course, it's done really, really well. At this stage, the macro has moved, adjustments have happened on the rate side, and, rates are looking extraordinarily cheap relative to history. But as far as the perfect market timing guy is concerned, you still have issues to get solved. RBI is still somewhat behind. US is actually the way it's behaving. It's breaking many developed markets, and frankly, this whole idea of Indian exceptionalism, this tape has run before, and I'm not certain that will sort of hold good. So for a speculator who wants to time markets, still time out there, 3 to 4 months out, most probably you will get much better yield than where it is right now. But if you're an investor and don't want to bother about for the last T and last 50 basis point, you don't care. It's just a portfolio adjustment, go and buy a bond, it's a decent yield versus what it was last year.
It's always a pleasure having you, and we love getting you on ET Now because you always give us ideas and new themes as well, right? Like you said, it's also about the timing. Look forward to more conversations.